This is the 10th module, Masterclass series, where I'm kind of taking you guys from the money mindsets of traditional finances to alternative investments. And no, so we'll start out here with a diagram of the debtor and saver mentalities. I think most of the folks here, if you're watching these webinars, certainly made it to the 12th module here. You're probably not in the category that I call in my new book, The Wealth Elevator. We talk about people being in the basement level. Most of us are at least on that first floor of the wealth elevator, where I started myself as an engineer back in 2007 after graduating college. Had a good salary, was a pretty good saver. At the time, I was able to save $20,000, $30,000 per year pretty easily. Obviously, I expanded on that as I got more and more rental properties, but I was still on this kind of saver track here in the middle. What we want to get everybody to is this wealth creator world where you're also implementing infinite banking or accredited investor banking. In the members portal, of course, you guys can check out that e-course on that particular topic, but using money to grow your portfolio, paying your loan back to yourself, your cash value increases over time. And this is how you get on the path of wealth creation. Been teaching this for quite a while. Started the podcast back in 2016. This is a fun flowchart I put back there because people are like, I'm fascinated about this stuff. Where do I get started? The first thing I've always started with is not everybody can do this, right? If you're in the basement level of the wealth elevator, you need to focus on personal finances. You need to get a higher income. You need to save money. Maybe as simple as personal finances, keeping a budget. And for some people who, if you follow some of these tracks here, if your household income isn't very good, under $40,000, $50,000, you're going to need to be taking a more active approach, whether starting your own business, flipping houses, although that's pretty risky in my opinion, and very highly competitive by everybody and their mother in that world. For the most part, if you are able to make a decent salary, $100,000 a year, and save a little bit of that, you can get on this first floor of the wealth elevator and start implementing these strategies. And we talk about three things in our world, which is alternative investments, tax strategies, and the infinite banking. The big one that I focus in a lot is deals, which is the alternative investments. Alternative investments is a term for everything that's not traditional. So traditional investments is pretty much everything that stock market certified financial planners sell, or what people call marketable securities. I've always stayed away from traditional investments. I've always done things on my own, bought my own real estate, or directly invested into an asset through a syndication. The reason why I like these types of investments and off of the traditional investment path is that I'm cutting out all the middlemen taking all my fees. Because very early on, I realized with my first buy and hold rental property, I was making 20 to 30% plus per year. When you break down the cash flow, the tax savings, the equity growth in a leveraged form, and the tenant was paying down my mortgage too. You can't forget that income stream. Now, some of that is in accrual basis, right? But nevertheless, my net worth was growing, and I was looked over to my 401k and I was like, why would anybody want to do that? Go up and down in a roller coaster at supposedly 6 to 8%. The next question that came up is, why is there such a stark contrast between traditional investments and alternative investments? And then I realized, and I met so many cool credit investors all speaking the same way, saying that's the middleman taking your cut. So a lot of those traditional investments are what we call below this line here. And to set this chart up, you got your lower risk investments on the left side, your higher risk on the right side. And generally what people understand those projected targeted returns to be. So a lot of these investments are going to be under your 8 to 10% threshold. And this may or may not include hidden fees or expenses. So it could be worse than this, but we wanted to just stack everything up relatively to each other here. So you've got your bonds, your money market accounts, online savings accounts would be categorized here in the left. And then you've got your REITs. So REITs invest in real estate, probably invest in the same things that we invest in. But when you're investing through an institutionalized traditional investment, again, heavy fees, and they may or may not be doing any value add too, doing physical renovation,
A lot of times we'll sell to folks like REITs, right? The REIT owners like these sort of really clean assets where there's nothing really wrong with it. So they can just sit on it and just be a very passive portfolio for them, which there's a fine line between a project that has some hair on it, and that's where you create the value. Obviously, we don't like to go through things that are less than 90% occupied or in disarray. There is something to be said about putting in value, force appreciating an asset. And when we get into the PE world, I think you guys will see exactly what I'm saying, where you're going into a business, you're changing processes, you're adding new revenues, maybe add a bolt-on, cutting expenses, morphing the business, increasing the value of any business in the PE space. 401ks, the reason why we position this here and stocks is because traditionally, at least from a personal finance point of view, it's predominantly stocks as opposed to bonds. And these are probably account for like target index mutual funds, those types, which if you don't know anything about investing, I suppose they're great for you. I think suffice to say, if you're listening to this webinar, you guys are ones that take a little bit control over your finances. That's what I'm so motivated to get people into this world is if you just educate yourself a little bit, don't get intimidated by all this. Wall Street wants you to just be intimidated and just give them all your money for obvious reasons, right? The fees, and so that they can take their cut. But if you have a little bit of aptitude towards this, you have some interests, get involved in this stuff, join our community, and it can lead to a lot more. Obviously, it's worked for me, so I'm very passionate about it, but I've seen how it's worked for a lot of people in the past. As a joke here, lending money to friends and family, that's a bad investment all the way around. Low return, high risk, that's what you want to stay away from. There's this concept called beating alpha. So alpha is maybe thinking of like beating normal, if you think about it. I would call the waterline, as we said it here, around just under double digits. Not to say that these are bad returns based on what you're investing in. The problem is the 401ks and stocks, the relatively high risk stuff, and you should be compensated with higher return, but you're governed by the fees and expenses in those types of products. Now, when you get into the alternative investing space, you start to get into this upper echelon of returns that some people think is a scam money. Who gets 20%, 30% returns in their money? Who doubles their money in a year? I think a lot of us have seen recent history, the crypto world, alternative coin space. I don't invest in those types of things. I'm not a huge believer, and it's very speculative in my opinion. I would probably put it in a category of venture capital. We'll get more into that here in the next slide. This is where the active investors, this is where the family office hangs out. The very wealthy people who have direct access and insider information into where the best deals are out there. In the stock world, you can't have insider trading. It's illegal. Now, some of the politicians, I think, have it, and people get upset by it. There's been a lot of laws put into place to prevent insider trading. I think that generally nobody has it other than the upper 0.1 of the 0.1% politicians, etc. For the average guy, if you think you have some type of inside track, please let me know. I would like to know. What's cool about when you get outside into alternative investments, like buying a rental property or an apartment, you have an inside track on that particular asset and you can buy it with insider trading information. And no different when you buy a PE deal, a particular business, right? You may know of some particular trade win or windfall that may be coming that business's way. For example, you could be going into an apartment deal, which has a pending insurance windfall coming. You can reassign the rights to an insurance claim that may or may have hit at $5 million or whatnot. That could be something that is very well known, totally legal to know. If it happens, great, but it's your decision to invest in a deal like that. But this is the world that opened up to me, especially when I started to meet other accredited investors. And that's why people join our family office, Ohana Group, the FOOM, to get around other high net worth accredited investors who are passive. And we have it on our checklist that you want to have at least a dozen accredited investors in your inner circle community. If you don't have that, you need to start getting that. Without that, you're just like where I was back in 2014, 2015. Sure, I had 11 rentals back at that point, but I did it all myself. I think people are surprised that I'm quite the introvert. I stick to myself. I get very passionate about helping people implement this stuff. And people tell me all this all the time when they come to the retreat. It's a lonely world being an accredited investor interested in this type of stuff. You can't really talk about this stuff to your friends because it seems like you're showing off or something like that. And you value your privacy too. So getting around other accredited investors is very difficult. There's meetups for real estate, but most of those people are non-accredited investors with no money trying to flip or wholesale houses or trying to get your money when you step into the mousetrap there. So it makes it very difficult for accredited investors to interact. And that's the name of the game. So you can get above this line. And I just threw a plethora of different investments out there that are more in the alternative investing space and above this line of varying levels of risk. Now, again, this is not scientific. These are just generalities. There's another concept out there called the Sharpe ratio. The Sharpe ratio says if you are somehow magically able to mathematically calculate the amount of risk a deal has in relation to the amount of potential reward, you want to have it follow a certain line, like this line, but maybe more out here. Obviously, when you do this, it disqualifies certain deals like lending money to family and friends. You would never do that, especially if you apply the Sharpe ratio concept to it. But this idea of where you want to be a mature investor, there are some investments that are high risk, but definitely worth the reward. And it's up to an investor to decide and ascertain this on their own. So this may feel like very uncomfortable to new investors, but over time you learn by doing and you learn by a community too. Just to point some of these out, maybe we'll start on this high risk side and work our way backwards. You've got venture capital startups. These are very high risk, high return. I would probably call this even higher than a 30%. Some of these can, double. We're not talking about percent per year return. We're talking about multiples per year, 2x, 3x multiples. But I just put it here in relation. These are investing in things that don't have any existing revenue yet. Angel investing, certainly. Land investing can be the same way. Very speculative, though. You could have to sit on that land making nothing for years on end. Development and flipping is high up there. This is where we broke down multifamily value add can mean very, very different things, right? You can go in with a bridge note and a much more aggressive quick plan, be in and out in 2 to 3 years or less. Or you can go into a deal where you're taking agency financing, 5 to 10 year loans and be in it for quite a while, more than 5 years. And the risk does too. Non-performing notes down here for those people who like to trade the paper on investments. You can get some nice returns there. It's other younger brother, the performing notes. And the difference between performing and non-performing notes, the non-performing, the person who is paying off the note isn't paying. So they're AWOL. We don't know what's really going on. That's why the risk is a little bit higher and the reward is higher, obviously. Now, working our way back here, you got your single family home rentals, your turnkey rentals, you got your second lien private money notes where your positions, where the equity line is very similar to some people like to invest in preferred equity, similar returns, slightly higher than 10%. You could find a particular deal where their distress level is a little bit higher. They're running a little bit dry on money. So normally maybe you could get 10, 12% in a note. But because you know the owner or we know the owner, you could negotiate a slightly better deal. We're looking to put together a note fund maybe in the future to take advantage of this. Some high net worth folks out there, and this is when I start to hang out with all these high net worth accredited investors and qualified investors beyond that, and this is where I get all the information for writing what's on that penthouse level or beyond the rooftop of the wealth elevator floor construct. For those of you guys who've read my book, there's a table in there, a little diagram of all these floors. And I've got in the mind of these higher net worth investors out there. And some of these guys, they don't invest in the deals per se. They just sit back and they wait. And they'll deploy $500,000, $2 million in a deal. When the deal gets to distress level, they come in as rescue capital. and they may put in $1 million and get 15, 20% annual returns on that. But on top of that, they might get 3, 5% as a quick fee, quick money right away. I've seen guys come in even as high as 10% a month. Some people think that's highway robbery, but if a deal needs it and long-term prospects make sense, it is not out of the ordinary. So that's where somebody who's well connected as an operator can really take advantage of other people and package that up for other investors in one of these distressed rescue funds out there. But not all of them are like. I think that's hard for investors to evaluate. That's just example of what's out there and what higher net worth people are doing. A lot of these investments are really more set up for the people on the second floor, third floor, and the penthouse level of the wealth elevator. Obviously, when you go above the penthouse level, your net worth is more in the $25 to $100 million range or greater. And then, of course, the first lien private money lending, which I think this is what people start off with when they go to the local real estate club. There's a house flipper out there that needs some money. So you lend money to them on their house flip. Unfortunately, you, the investor, don't get the upside. You take on all the risk. The house flipper partakes in the upside of that deal. And normally about 10%, 12% is a normal. And a warning here for some of you folks who are getting like 13, 14, 15% or more on a house flip, really scratch your head because you're likely working with a newbie house flipper. The only reason why they would be paying that much is because they're desperate for cash and they can't attract anybody else based on their track record. So not all deals are equal. I just put that there because maybe a fraction of our community comes in through the private money lender world from the house flipping space. But again, this is residential properties, very highly competitive, a lot more risk than most of these here are in the commercial world, more institutional, higher quality assets at the end of the day. One thing you're trying to do here for a lot of people is get off the beaten path, move from these things we're very familiar with in the traditional investment world and step people up slowly into things that make more comfortable. The analogy I like to use is sushi. For those people who don't eat sushi very much or maybe tried it recently as an adult, normally your buddy who has sushi has you try the California roll, right? No raw fish, it's imitation crab, there's a vegetable in there, you just soak it in soy sauce and you're good to go, right? When I started, and I just started with turnkey rental property, and then you move up to the shrimp tempura roll, and then at some point your buddy sneaks you in with the spicy tuna, which is actually raw fish. So then you're moving up on the scale of more exotic sushi. And this is where maybe this is similar to when I started to get involved in syndication private placements in 2015, when I was scaling out and selling off all my rental properties. And maybe the uni is investing in venture capital and private equity, which in recent history, my secret is like I have my inner circle of other general partners and other investors on my level. And we talk just like how you guys should, right? You guys should be having a cohort of people around you. You talk and you also get good deals, you build relationships. This is what I do on my side personally. What are you guys investing in? As a group, we transform ourselves. Real estate was really good from 2010 to 2022, 23. We had a recent correction. Interest rates are still relatively high, and they're predicted to be high in the near term and midterm future. This is what's opened up private equity deals as a better solution. And things change, right? I think in this, depending on when you're watching this webinar, things may change. For example, we're going to get a little bit into infinite banking versus taking money from your home through a HELOC. If you would have came to us a few years ago, the HELOC would have been the huge way of doing that because interest rates were low. You could get a HELOC at a 5% rate. Now today it's way, way higher, and the infinite banking rate at 5% or so is lower. So that's the option that is on the pedestal now, where again, 3 years ago, the infinite banking was the secondary option. This is where we're not giving any financial advice here. You guys have to make your own decisions, but at least be aware of what's out there in the galaxy and not just be like most people who are stuck below this line in traditional investments, because that's exactly what Wall Street wants you to do. If this is all new to you, don't be ashamed. I went and learned those dozen types of investments. It took me, again, from 2010 to 2025, still learning. So it took me over a decade to see this a section at a time. So let's break this down more on my personal story here. I went on this as a more steady, stepwise fashion. People do funny things late into the night on their spreadsheets and PowerPoint. This is from my personal private files. I don't know when I took the screenshot. It must have been from like prior to 2020, but I attempted to put all my real estate holdings on a diagram based off of Class A properties here, Class C, and then more of the yield plays, which is the opposite of heavy reposition developments. And this is the way I was mind mapping to myself and just checking myself that at least my real estate holdings were more scattered in a way, or at least where I wanted it to be. Like, for example, I think if I wanted to invest in a deal, it would probably be more of a B plus class property that had a good amount of value to add. So I guess I'd be clustering around here. Obviously, there's a whole bunch of stuff here. There's a whole bunch of stuff here. So it was not that case, but maybe the weighted average would have been where I intended it to be. No deal is going to fit your buy box the way you want, and you have to diversify. You can't just get into 1, 2, 3 deals. You got to look at it more like 20, 30 plus deals to adequately get that weighted average where you want. This took a long time to acquire these types of projects, and maybe it might take a guy, even if they're well connected and conscientious about it and joined our group and got plugged in with a network and got a lot of deal flow, maybe they would do a deal every quarter, assuming that they have the funds to do that. It would take you a long time to get all these circles here. And going back to that really confusing chart of all those investments, now that I thoroughly confused you, I wanted to try and rein you back in and simplify it a little bit. So when you look at a deal, it usually follows in one of these 5 categories on this investment spectrum. Again, the risk and growth is more on the right side here, high risk, higher return, and the security is more on the left side. So on the right side here, high risk, high return, venture capital, angel investing, things that don't really have any profit yet or even any income. WeWork was essentially venture capital. They raised a whole bunch of money and they just spent it like drunken sailors, hoping that the company would go. What we like to invest in are things that produce income and have positive cash flow, positive EBITDA. Apartments that we take over, we look at the last 2 years of financials and we evaluate it. We make certain projections on things that we can improve, like renovating the units, which is obviously not rocket science. And we make an assumption of what the income will be. And most times in real estate deals, we're not decreasing the amount of expenses, but increasing it because we're adding to the services which tenants pay more for. But that can be very much predicted and modeled out. So those are these 2 categories right here. In the real estate equity investing, there's a whole bunch of different deals, right? This kind of square, you can have higher risk real estate deals where you're in and out in a year. You have lower risk where you have agency financing and it's maybe a 5 to 10 year play. But just putting this in terms of, I guess, planets. You have venture capital planet, you have PE planet, you have real estate planet. Planets are huge, but when you zoom on out, this is how you'd arrange the planets together. Debt investing, I think this is where it blends with real estate. This is where you can lend money on an asset and you're positioned higher in the capital stack. So your security, in case the asset's value goes down, is a lot more secure. However, we know with less risk, you typically have less return. And if you're looking for something that's almost risk-free, nothing here is risk-free, obviously. That said, it doesn't have very much return. Life insurance is usually like 5% returns on that. Obviously, other reasons why you do it. T-bills would probably put in here. Bonds would probably be put in here. This is a way of looking at your portfolio, and essentially you have to come up with your own portfolio allocation mix. One thing that I personally do, again, I'm not a certified financial planner, guys. I'm just telling you what I personally do. I take a barbell approach. So a barbell, if you're thinking about in the gym, and the 2 ends are very big, in the middle is very small. I take an approach of where I'm going into alternative investments. I would say alternative investments are more on the riskier side, but I do think that it has outside return potential. So I personally believe it's a good risk adjusted return. And I have a lot on the no risk side. So that's how I do it. And the skinny portion of the barbell in the middle, I don't have any Wall Street traditional investments. And you may think that's crazy, but when you get around our world of accredited investors, that's not crazy. A lot of them don't have any of those traditional investments either. Now, I certainly think that when your net worth goes over $5 million, certainly when you pass the age of 60 and you got to think about your mortality, I do think having a certified financial planner on your team makes a lot of sense. And I am in the process of talking to other folks in the industry, seeking out the best ones. You really want a good one, right? Not the one that works for one of the bigger financial firms, because those are just run-of-the-mill financial planners, right? But for folks who are not yet to that scale, you want one that works with more higher net worth people. So again, breaking this down and just giving people sort of an ideal, something to start with, right? This is not a suggestion of actually going out and buying these particular investments, guys. Use your common sense here. But I just wanted to show people how one would go about. The analogy here is like building on your Lego sets, you're building your blocks. It's very different than going into your 401k Vanguard portal and just clicking a bunch of buttons. This is you're working in terms of bigger chunks, and bigger chunks for you at this time when you're starting out. But this is where when you have a portfolio of dozens and dozens of these types of projects, it starts to become very granular and emulate a lot like a traditional 401k portfolio where it's just percentages at the end of the day. These types of private placements and syndications, you're going in more directly into the investment. Therefore, the general partner sponsor of it doesn't want a gazillion investors. That would just be too costly in terms of administrative costs and other headaches. So there's a certain balance. In most deals you see out there, usually the minimums are $50,000 to $100,000 per investor into that deal. Anything less, I would really caution even investing in the deal. At one time when we first got it started, we would take guys in at $30,000 a piece. Within our industry, we all talk that those are the worst investors to bring in because they just don't have the money. There's another reason why we stopped working with non-accredited investors. And it's the folks that don't really bat an eye too much at $50,000. Those are the real investors out there that can repeat invest. And that's where more institutional firms, where the investor splits aren't as good. A lot of this is covered in the syndication e-course. Some of the GP-LP economics gets skewed more in the GP's favor, and the fee structure gets more skewed in the GP's favor as a firm gets more and more mature. So there's sort of a spectrum of operators, right? You can go to the guy who just did a weekend boot camp and just got started, like how we were back in 2015. And you can maybe get 85-15 splits. 85 goes to LP, 15 goes to GP. You can get in with maybe $30,000 minimums. But good luck, right? That was where I made a lot of initial mistakes as an LP and a GP, working with just unproven people. And then on the other side of the spectrum, you have more institutional managers who they don't want to work with anybody who's bringing in a check size of less than $1 million or $500,000. And the fee structure is more skewed in their direction because they have a big firm and team to pay their salaries with. So there's a spectrum, and I've always said you got to try and find something that's in that sweet spot in the middle, which I think that's what we are, right? Like we try to have this ohana of investors where we get to know people here. We make ourselves accessible, although it is getting tougher and tougher these days. We're getting over 900, 1,000 live investors, done over $2 billion of deals. Certainly it's becoming a bigger thing. Obviously expanded the team to help out with this because the first several years, it was just me doing everything. And obviously now I got to focus more on the deal flow side and the acquisition side. But I think the education part of this is very important. That's why I still get involved. And this brings me a lot of joy to help people get started in this world because it was difficult for me to step out of single family homes into this space because who talks about it, this stuff? So back to the slide here, the idea is you start to layer your investments together and build your portfolio over time. Unfortunately, if your buying in the beginning, you're not going to have a very diversified portfolio, and some of it is timing. Folks that got started in 2021, 2022, bought at the peak of the market, it's tough for those people. After that, the market corrected, so maybe now is a much better time. But I think after a while, you want to spread your portfolio over 4 to 7 years so that we know that a market correction is going to come every 5 to a dozen years. We just don't know when that's going to be. So the only other way to mitigate that is to diversify and to be able to absorb those ups and downs. So this gets into what do we do now? So you got to ask the question, where is your laziest equity at? Because I think a lot of people, like in particular, they may have rental properties or home equity that's not making very much money in there. And the idea is to get that money working, especially if you're under $2 to $3 million net worth. If your net worth is $5, $10 million, sure, you can buy your house cash. You can buy gold that barely appreciates and just stick it under the mattress. You can do whatever you want. But where I'm coming from is when your net worth is less than $2 to $3 million, you need to still grow your money, and you need to do this prudently. And so going back to that case of some people have this idea of paying off their rental properties, which makes sense if your net worth is high. But if you're in the growth stages, this is more of the conceptual plan that you need to be doing. As I mentioned earlier, when I broke down the returns I got from my little rental property when I first got started around 2010, I was making pretty good returns every single year. But as the property appreciates and you pay down your mortgage, you have a higher equity position. So it's not really return on investment, as I point out here, but it's return on equity is the big thing here. Return on equity. So the way it works is as the years go by, your return on equity goes down. Now, at some point, you have to refinance, sell, or do a HELOC to extract that equity and get it redeployed. Now, I'm not a huge fan of 1031 exchanges unless you're making a capital gain of over several $1,000,000 or some more advanced strategies like that. You can reach out. We can refer you to folks who do that. What I would urge you if you're in this situation is go check out my masterclass on mitigating tax gains. It takes you through, I think, maybe 7 different methods just to unlock, and we can have a conversation after you go through that masterclass. Once you get the money out, you re-leverage it into the next deal or multiple deals, and then you reset the C curve over and over again. Now, if you're like most landlords out there, you ride that curve all the way down 10 years, 20 years, where you're barely making any money. Now, a case in point in this, if you're in California and Hawaii and you have a rental property all paid off, that's probably $1 million that's locked up in that asset. And if you're renting it out, you might rent it out for $4 or $5 per month. But we all know like half of that goes to expenses, taxes, insurance. Hopefully your tenant doesn't drive you crazy, especially if you're in a blue state. But you may only make $2,000 per month on that $5,000 rent check. I'll call it $3,000. So that's if your equity position is $1 million and only making $30,000, $40,000, that's less than 5% return on equity. If you remember back to that old chart that we just went through, that's a horrible rate of return. It's an alternative investment, technically, not technically, but it is an alternative investment, but the returns are horrible because the debt structure isn't optimized. It's like you're on a sailboat, the winds are going well to your back, but you don't have the damn sails up. It's silly, but this is what a lot of amateur landlords do. They don't take this into account. So here's to give you a framework of some options out there to get you started. Now, based on when you're watching this webinar, some of these options could be flip-flopped, but traditionally the HELOC is the first way of tapping equity into your current rental properties or your home because it's temporary and there's no fees in it. The problem is you can't get all the equity in the house, but it'll get you going. I think that's the big part is just start to investing, getting going, and then you start to unlock the network of other people and you get more and more comfortable. Eventually you do a refinance on the house. And this is where I ask people, the rental properties, I think once people get into this world, they're sold on it as I did, and you start selling off the rental properties. There's some good websites out there to sell the properties with the tenant still in place. They attract a lot of unsophisticated turnkey investors. I won't say what it is on this channel. You guys can reach out and we can connect you over to those people. But great way to get rid of your turnkey rentals or rentals with existing tenants in place. Another way is to just do a cash out refinance on your home. And this is a way of tapping even more equity in that house, because the HELOC normally you won't be able to get at the last 20% of equity in the home. But this is where also sometimes I ask people on onboarding calls, do you want to live in that house or you want to keep the rentals long term? This may be the motivation to downsize or move and just to unlock that money. Similarly to like another way that people get assets to invest is through 401ks. I know another guy helps people change jobs just so they can lock that 401k, because the way 401ks work with most employers out there is you can't really touch the money and self-direct it into a solo 401k or a self-directed IRA until you've left the employment of the employer. There, similar concept, but two different sources of money. The other one here, and I just want to put in people's head, I know it's not practical for a lot of people and it will cause your spouse to divorce you. But the reason why I got to where I'm at was in my 20s, I was able to not live anywhere and just rent. And I was able to plow away $50,000, $100,000 a year to down payments or investments every single year. And that's what set me up to my 30s and now today. If you do the math, especially if you live in an area where the rent to value ratios are under 1%, it makes sense to rent, especially if you're buying a house that's more than $500,000, $600,000. The reason being, real quick, is that the down payments on those properties are so huge. You have to do the math on if you would have taken that huge down payment and put it into investments. Of course, a lot of different investments, varying levels of risk and reward. You have to do the math on your own and assess the risk. Another way, like I said, deploying retirement funds. But the reason why the equity in houses are always first, especially for a HELOC and cash out refinances, that's not a taxable event. When you sell the asset, it is a taxable event. But like you said, there's ways other than the 1031 exchange to get the money, defer your taxes on those sales. That's what I did in 2016 or 17. I sold off 7 of my rentals that year, and I had a $250,000 capital gain that year. But because I was investing in syndications that year and prior, I had built up several $100,000s of passive losses that I was able to use to offset that. And that's what people call in our world the lazy 1031 exchange. And that once you've deployed funds in your retirement or HELOC, that's where you start to, in a way, look through the look for coins in the couch and look for other assets that you may have that earn less than 5%, then 10%, then 12%, you keep marching up. So that's what we did. That's actually how I got my wife to start investing. She had a condo. We sold it. I talked her into renting, which we still do today. She was able to invest it in a deal. And I think we doubled money on that one in 3 years. And I guess the rest is history. We're still together to today. Never can count on the future, but we're still today and it's been working out. So sometimes when I just put it more on paper in a different form, make a plan, put the years up on the top, and then these different sources of funds. Everybody's situation is a little bit different. I find this kind of fun, right? It's like a little puzzle where you say, we're not saying where the money is going to go, but we know that where it's going to come from. That's why I call it a deployment plan. And you can make a plan based on your situation and where the money is coming from first. So the first place is always going to be your heart, sweat, and tears, your annual savings. Again, most of the people in our community save at least $50,000 to $100,000 a year, some much more. So that's where you deploy from first. And then cash savings. And then this is where you start to tap the home equity or the retirement funds, which we call qualified retirement plans in various orders, right? Everybody's situation is a little bit different based on your taxes. If you're in a higher tax bracket, you may do the home equity first because these will be taxable events by taking money out of your retirement account. And vice versa. If you're under $380,000, $400,000 adjusted gross income, you're in a relatively lower tax bracket. So this might be a better way of going first before touching home equities. Every situation is a little bit different. And then you also layer on top of that, plowing money away through an infinite banking policy and kind of making money in 2 places and playing that loop there, which we'll show a table of that here in a bit. But you can have various different forms of this. Every situation is different. If you haven't jumped on an onboarding call with myself, we certainly can have a discussion and I can give some input. I don't know your entire pictures, but we can chat. And I think this is fun. I'm not giving any financial advice, but just different ideas. What I like to do is I just like to fill people's heads up with ideas. But what really brings it alive is when they talk to other folks in our community, join the mastermind group, and then you hear their kind of kooky ideas too. And then now you're able to also have conversations on what exactly you should be doing. Some general ideas here. It's not about getting into 1, 2, 3 syndication deals and make great returns. That's really not going to move the needle, guys. Like, this stuff isn't magic. This is not a get rich quick scheme. If you put $100,000 into a deal and it makes you on average 10, 20%, or even 30%, is that going to change your life? No. What this is a holistic strategy of deploying gradually over time. Slowly, you get slightly better returns. And then some of these deals will have better tax benefits, like the real estate. That's what in turn lowers your taxes over time. And then you flow it through infinite banking. And it's this combination of these three things working in conjunction. I think people get enthralled by these higher returns, but unless you put a larger chunk into it, you're not going to really see the impacts right away. Now, if you want to gamble and put 100 grand in some altcoin where you could make 5x, 20x, yeah, that'll change your picture. But I don't play that game. At least I've never in the past where I do that quite of an asymmetric type of play. What do they say? Like on angel deals, angel investors, they might invest in 20 deals, but they lose money on most of them. Maybe only one of those are winners. But boy, is it a winner, like a PayPal or something like that. Although, of course, if you even had access to the deal, that's the big thing. That's on the skill in angel investing in venture capital, if you go back to that earlier slide that we were discussing earlier. What I think is the key is maybe not getting these higher returns in individual deals, but it's more of a game of stop doing the things that are hurting your average rate of return. So look through your portfolio and what are the things that are making pretty much nothing, under 5%. And that's typically home equity or maybe just cash just sitting there. It's the idea of why am I not getting physically fit and why am I keep gaining weight? I work out so hard. I do these wind sprints up the hill. But when you look at it, it's what are the things, it's not the exercising, it's just the simple things. So you go to eat Jack in a Box late in the evening. You do these things that are hurting you. And that's the same concept here. So sophisticated investors always monitor their return on equity as opposed to just feeling good about the initial return on investment. If that doesn't make sense, go back to that earlier slide where we talked about the return on equity slide. And remember, return on equity is your profit divided by the total deployable funds in that particular asset. So take that into account when you're taking a look at your primary residence or your existing rental properties. Now, this is a Sankey diagram. There's a website, if you Google it, that you can make one on your own. I think it's a great way of communicating this to your spouse. In most cases, there's one spouse who leads the interaction with the finances. The other might be interested, doesn't have a huge amount of interest in it. Obviously, you want to keep them involved and communicate what's going on. So this diagram is a great way of visualizing what's going on out there. Back in, when did I graduate? 2007. I had a decent income. I was a good saver back then, and I was able to save my money. But it wasn't until I started to pile on investments out there and then started to get into the syndication deals, phased out of the rental properties. But all the time, the savings went up. And at this point, it became like a third paycheck a month for me. And this is the idea. Look how long this takes, right? This is not a get rich quick scheme. It's slowly over time. The other big concept in this, and this is super common sense, but I just wanted to point it out that at the end of the day, this is about personal finances. The more that you can push into investments, the more you can augment your month-to-month savings and your cash flow. This is a breakdown of people's total spending per year based on their income and income growth. Most people think of what they get paid at their day job or their business. That income was obviously growing based on the investments. The more you make, the more you're able to save. So you can look at this two ways. It's all about the pizza here. This wedge is what they call it. The more money you make, the more you can spend and invest that difference. There's a concept out there saying, what do you focus in on, the income or the expenses? There's arguments both ways. I'll discuss the differences, but most people will agree that you have more impact on the income. Get out there and play some offense. Get a promotion at your job. Get more salary. Invest more so you can get more income from investments. Create a side gig. Propel your business. Invest in yourself to get more revenue. What I'm saying is increase your top line income as opposed to worrying about cutting expenses, not having your $6 latte. I think something can be said for cutting costs, but I think generally speaking, most people will agree that improving your top line is going to do more to your bottom line than worrying about being a miser and saving. And this flies in the face of traditional personal finance, by the way. If you guys have read The Millionaire Next Door, I got news for you. The millionaire next door doesn't have enough money. Realistically, you're going to need to get to that level of $4 to $5 million by the time you get into your 60s to have enough. Inflation is going to eat that so-called millionaire next door with the Camry. They eat their shorts. That's just not enough. And the way you do that is with getting off the traditional investment path in the beginning and going to these alternatives and now unlocking the tax strategies and then also throwing under the infinite banking. So one more concept here, this concept of the freedom number, or what we call the passive cash flow number. Think of it more like a velocity concept of like how much passive cash flow your income, your portfolio is generating on a month-to-month basis to be able to freely spend that with your personal expenses. Some people call this the critical mass number, or where you hit zero gravity. You think of a spaceship that blasts off into the atmosphere and breaks the atmosphere and goes zero gravity at that point. When your investments make more money than you can spend, and then it just keeps compounding on each other. Good problem to have, or just the simply FU money concept. So it's not a net worth target, it's a monthly number. And for a lot of you folks, just to throw a number out there, it's usually between $15,000 to $50,000 per month. And we backdoor it into the net worth number because that's a lot easier to calculate for folks, especially getting started who haven't turned their portfolio into a cash flow portfolio yet. Is $4 to $5 million net worth using the 4% extraction rule. Obviously, a lot of different factors out there, like your age, how many kids you have, what age range are they in? If you have adult kids who are already financially on their own, maybe not financially independent themselves, but financially on their own, you may only need 3. And obviously your lifestyle. Some of you guys have expensive tastes. Some of you guys still live pretty frugally, and that's just, they become part of your identity. One little tidbit there, as far as like creating trust for your kids, most people will say that the magic number when kids become adults and have become their self for the rest of their life is usually about 35. So that's the age of when people will transfer funds to the kids at that age. Obviously you're hoping that they're not a crackhead at that time. I've seen it a lot of times where people who are already past that stage in life get a whole windfall of money, and they don't go out and buy the Lamborghini or do something stupid with the money. They are who they are at that point. Obviously, I hang out with a little bit more financially conscientious people. So the idea is to diversify. You could have more of a cash flow focus or equity focus portfolio. So 2 different data points here, just to sample. You never want to have more than 5 to 10% of your net worth into any one asset or deal. That's certainly not diversification. It's harder in the beginning, right? When your net worth is lower. You want to have a startup phase with just test driving 10 to 20% of your net worth is normally what I see our investors start off with in the first 2 to 5 years. And make sure you try to spread that out over 4 to 7 years. Obviously, that's not going to be possible at the beginning. But again, that's what's going to make things a little bit more safer for you in the long run, because a market correction is going to happen in every asset class. Stocks, real estate, everything has a market cycle where things go up and down. And then obviously you want to have many deals, several dozen. And if you think about it, it might be daunting, but the idea is a deal a quarter for a year, over 5 years, that's 20 right there. And you're on your way. So like I said, you can have more of an equity growth focus mode or a cash flow focus mode. Two ways of getting to generally the same place. I think most people who are age of 55, 60, I guess that I would define that as younger, under the age of 60, may opt to do more equity growth focus mode. People who are already in retirement stage of life may pick the cash flow focus mode off the bat. You're going to be diversifying into many deals across the spectrum. If you remember back to my chart earlier of all my scatter chart of all my investments, they aren't always predicated on one area. Just like that other 5-block chart with venture capital, PE, real estate, debt investing, you're not going to just pick one of those squares. You're going to diversify over a spectrum. And this is where you have an infinite amount of commutations. And this is why there is no normal out there, guys. But you want to figure out what your passive cash flow number is, whether that's $15,000 per month or $50,000 per month. You want to stick a flag in the sand and say that this is what I'm trying to shoot for. This is what I need. I will be the first one to tell you that you will likely be wrong in your prediction. And this is the concept of, I want you to start walking on the moving escalator first before you really start to land the plane on what the heck that number is. The reason why I'm saying this is a lot of you guys come to the retreat. We'll do some personal finance exercises. What is my burn rate? Do I really spend $10,000 per month, or is it more like $25,000 per month, or vice versa? If you haven't yet even have $5,000 of passive cash flow coming in, you're like this little guy right here just sitting there and thinking, yeah, I'd like to have $15,000 per month. So I don't really believe that you're a really good predictor of what you really need until you start to walk on this moving escalator. Another thing, I think unless you have $500,000 of your net worth into alternatives, I don't know if you even have a big enough cash flow income source to be able to adequately predict what your passive cash flow number is. Some people are just brand new to this world. Maybe you have never owned rental properties. So the name of the game is just getting the first one and getting moving. And this is where hopefully we've tried to unlock a lot of these concepts for you in this masterclass series. But really, you need some community around you, right? You need other people on this journey to go up with you. Maybe not necessarily carry you, because we're all in this journey on our own. But if you surround yourself with a community, I think it makes it a lot easier. Certainly makes it a lot more fun. What I would say is get moving, get $5,000 of passive cash flow first, then come back and reevaluate this passive cash flow number. Most times what, at least from our community, is you guys will overshoot your target. You know, you may say that I need $25,000 of passive cash flow a month, but when you get going and you start to get $5,000, $10,000 of passive cash flow in your portfolio, and you start to feel what that is, that's the huge thing. You got to feel real life what that is. Then you may realize that $15,000 is more than enough. And therefore, you could have retired 2 years ago, like how we've had with some individuals in our mastermind group. And now they're trying to figure out what to do with themselves. What's the next journey after trading time for money? I think more times than not, a lot of us are, I don't want to say scarcity minded. We are more conservative in nature. So that's the reason why we overshoot this number. We see this concept. We do hot seats in our mastermind group where somebody will come in and divulge their financial picture. And a lot of times the group will look at it and it'll be like, man, you've ran 32 miles in a 27 long marathon. Dude, you could have stopped a while ago. And that's where it's a little sad in a way. Like my whole idea is like people set a number and then they get to that number and then they relax and chill. We've coined the concept of T-bill and chill, where you just put your money in T-bills and life insurance, something really simple and almost risk-free, certainly low return, but you have enough, right? You've hit that critical mass point and you de-risk your portfolio at that point. So said in a different way, get to at least a 20 to 50% of your goal number, and you're going to start to see that goal starts to move on you, more than likely come closer to you. I think most people overshoot it. And again, I think most people in our community, $15,000 to $20,000 of passive cash flow a month. I think a net worth of $4 to $5 million can get that for you. So you certainly don't need to get past 8 figures. If you get there by the time you're 55, I don't see why you can't get to well beyond $10 million net worth by the time you get to your golden years at the end, right? It's just compounding interest at that point. So going back to my story is a little bit different. I've turned myself more into an entrepreneur, helping people along this path. Taking us back maybe a couple decades ago, I was the supervisor here on the left. These are some of my guys. Man, was it cold back then in the morning briefings. But a lot of this was stressful, traveled a lot. Luckily, I didn't have a family at that time. You have the toxic people culture in any Fortune 50 company. But I walked this path of going from step to step. Got some turnkey rentals, stopped doing that in 2015, got into syndications and private placements. I probably should have gotten off the beaten path and just retired a while ago, but I'm in too deep. And I essentially, the way I look at it is like helping you folks along this journey is my passion in a way. We have a lot of people who join our mastermind group and we move them things around and allows them to create that lifestyle that they want to quit their job. But then now they stay in the group because they like the community and it's about social relationships at that point and also searching for the next passion. There's a concept called ikigai out there, which is the combination of four things to find something what you love, what the world needs, what you can be paid for, and what you are good at. At this point, if doing pottery is what you love and what you're good at, fine. That's called a hobby, by the way. But if that's what you're good at, then that's great. But I think most people search for this, what is their ikigai out there? And that's what, for me, is I enjoy connecting with new investors, helping them along their journey, and then cultivating the community. When we have the retreats here in Hawaii or wherever we do them, it is a magical weekend for sure. And goes well beyond just talking about finances. I think too often people are stuck in this rat race. This is the final slide here, pulling it all together. The idea is you trade time for money. You throw the free cash flow from that after your monthly spend, you put it into an infinite banking, a credit investor banking policy. You flow it through some real estate, alternative investments, as you mentioned, a myriad of earlier in the presentation. Some of the investments cash out or they have cash flow from the investments. And this is in the growth years, you put it back and you pay back the loan and then you do it again. And you're making money in two places, the purple and the green. The infinite banking policy, the life insurance policy is growing, and the purple investments, obviously, they're heading in the right direction too. At some point, when you hit that critical mass point, you pay back your loans and then you go on a nonstop vacation. And that is the big high level picture on how this all plays together. This is a screenshot of my book here. There's a diagram for the floors of the wealth elevator. Most of you folks, I'd say on the second and third floor of the wealth elevator as accredited investors. But the idea is we talk about strategies of what people are doing on the penthouse level. These are the secrets and tips that I'm uncovering from my network that I bring back to you guys. And some cool stuff out there that not a lot of people talk about. But the key of getting there is unless you get off the beaten path, to me, I don't see there's a way of getting there because the returns aren't there because Wall Street is taking your returns where you take on all the risk and you're going to be killed by taxes. Unfortunately, people are always stuck in the basement level, which is not even shown here, and the first floor, which frustrates me. And that was why my parents did it. They did it the traditional way. Thank goodness I never listened to what they did financially. But it made me test different things out there. And I discovered this alternative investing, alternative finance path and uncovered this wealth elevator myself. And now, as the metaphor suggests, we try and send the elevator back down. So especially if you're somebody who's already on the third floor and you want some community around you, join us. We want to try and make it where people help out each other within the group. And at the end of the day, send the elevator back down for other people. If you haven't yet, check out my book, The Wealth Elevator, found on Amazon. If you guys have already got a copy, thank you for purchasing it. If you want to share it with a friend, we can send you a secret link at thewealthelevator.com/secret share, where you can give a free copy to your friends and also get the MP3 PDF version. If you guys have any friends who think might be interested in it, you can also connect them and get this masterclass version or the audiobook. I think both kind of resonate with different groups of people. I think the masterclass that you guys went through was a little bit more granular than the book, whereas the book might be good for newer people, right? Because it's a little bit quicker to digest than, shoot, it's been like maybe 12 hours of these webinars. But if you got a friend, connect us via email and we'll get you a free copy of the book for sending people our way. And that way you also have a study buddy to go through the syndication e-course, which I think is the next step after you've completed this masterclass series. Go into the syndication e-course. Usually takes people 8 to 10 hours to go through. And then of course the infinite banking e-course. And if you hadn't had a onboarding call with myself, book a call with myself. If you want a life insurance policy illustration, or you want to evaluate your old life insurance policy to see if it's up to AIB infinite banking standards of today, let us know. But anyway, we can help. Shoot us an email at team@thewealthelevator.com. And thank you all for listening in.